There is one monthly dividend stock that has produced a 110% total return and has put 13% cash yield in investors' pockets in the past 5 years. Hey Bowtie Nation, you know we love the monthly dividend stocks here on the channel, but there is one that stands above all the rest for dividend yield and price return. One monthly dividend stock that I'm buying above all the rest. Of course, you should never have all of your money in just one stock, so I'm going to be counting down the 7 best monthly dividend payers, along with what to watch for in these stocks, a warning to investors, and how to combine them with your other stocks. I want to get started on our list with Gladstone Investment Corporation, ticker GAIN, and its 6.9% dividend yield. Now, Gladstone is the lowest dividend yield on our list, but made the cut of my top 7 for its 108% total return over the last 5 years. That's a 24% price return on top of the dividends each month, but stick around and I'm going to show you the complete list of all 20 monthly dividend payers, their yield, and the returns at the end of this video. Gladstone Investment is a business development corporation, a BDC, which takes equity positions and makes loans to mid-sized businesses. These BDCs make up the majority of monthly dividend stocks because they get a special tax break for passing through all their income to shareholders. But it is important to note here the difference across BDCs and how it's going to affect those stocks. For example, Gladstone's target investment of 25% equity position and 75% debt versus most other BDCs that aim for less than 10% equity in the businesses they work with, that higher equity ownership means higher risk for Gladstone, but also higher returns on these investments. And we see that in Gain's history of return on equity, which is well above the industry average. The company reported its ROE in March at 18%, versus the average return on equity around 12% across BDCs. We also see here the total return on the shares has outpaced the BDC group in 5 and 3 year periods. But then another result of this higher equity investment versus the more stable cash flowing debt is that the company does pay that lower dividend yield, and instead you see that stock price rise faster than maybe other monthly dividend stocks. Prospect Capital, ticker PSEC, hasn't done as well on price return, with the shares down 11% over the last 5 years. That's why it's only 6th on my list, despite that high 12.9% dividend. Prospect is another BDC, founded in 2004, with over 16 years of dividends and performance. The company manages an $8 billion portfolio of 122 investments in companies across 36 industries and earns a 10.1% yield on its portfolio. That is quite a bit below the dividend yield, but the company has been able to manage it to keep that dividend payment over the last 5 years. Prospect has been able to pay out nearly $21 per share in dividends, more than $4.2 billion since its IPO. And if you only focus on dividend cash flow, you might take another look at this stock. So when we do look at that full list of monthly payers later, you're going to see that Prospect has produced a 50% total return over the 5 years. And that works out to about 8.5% annually. That's the dividend yield and the price return together. But I'm going to show you later how to get something back on that drop in price, a portfolio strategy that turns that falling stock price into your favor. We'll get back to our account down to the top monthly dividend stock I'm buying. But if you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, look for the link I'll leave in the description below. These are the stocks I'm following in those major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and then they're going to email you that full report with the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link in the description. Horizon Technology Finance, ticker HRZN, with its 11.4% dividend, takes me back to my venture capital days with its strategy. Horizon makes secured loans to venture and private equity-backed companies in the life sciences and technology industries, a $26 billion addressable market. That venture capital side of the market has taken a hit over these last few years, especially in the Silicon Valley set, but there is no better market for growth for the BDCs like Horizon. Case in point here, the average yield on portfolio debt for Horizon is 16.8%, well above the 12% dividend yield, one of the strongest spreads I've seen in a BDC stock. That's helped the company grow its dividend by 10% over the last 5 years and has produced a 62% total return, but the share price has really gone nowhere since over that time, so it's pretty much all the dividend return here, and that's why this one is so far down on my list. Where a lot of monthly dividend stocks, I'd say most of them, you're never going to see much price return, if any. Once that venture capital market does rebound, you've got the potential for more upside here on Horizon. PennantPark Floating Rate Capital, ticker PFLT, is another BDC with a solid yield of 11% and more safety in its structure than most of these, but again, this is further down on the list for that price return. But again, that might not mean quite as much to you if you only want that highest yield possible, that biggest dividend check, and you'll want to go with one of the others in our full list at the end. But for my ranking, for my portfolio here, I'm trying to strike a balance between that price return and yield. PennantPark is a BDC, but specializes in floating rate loans, a unique advantage it's had over other BDCs in the last few years. 86% of the portfolio is in secured debt on its first liens, with another 14% in equity investment to give it that more upside growth. That high percentage of loans in first lien status is going to help protect it in any downturn in the economy, while the higher equity position will help it rebound later. The company's current portfolio of loans to 141 companies is diversified across more than 30 industries, with an average loan size around $9 million. The 10% average portfolio yield again here isn't as high a spread over the dividend as I'd like to see, but this company has a history of performance. All in all, that first lien status and floating rate, along with the diversification, has helped it double the dividend since 2011. That kind of growth that's hard to come by in volatile BDCs and these monthly dividend payers. Their shares are down 2.5% over the last 5 years, but with that higher yield, the stock has still been able to produce a strong 66% total return over the period. That's actually the fourth highest total return among the 20 monthly stocks that I follow, so that, along with the safety in those floating rate loans, makes this one to watch. We've still got 3 more monthly stocks to highlight, including one with a 17% dividend yield, and that complete list of monthly payers, but these cash flow machines are not without risk. I'm going to briefly explain the pros and cons of monthly dividend stocks, how to find the best for your goals, and then 2 dividend portfolio strategies that you need to consider. Now, the pros of monthly dividend stocks are pretty obvious here. That high yield cash flow of up to 17% is more than 10 times the dividend you get on the broader market, like with the S&P 500 index. Because most of these companies pay no income taxes if they distribute all their earnings to investors, it's also an extremely efficient business model. That means you aren't paying the double taxes that you do with regular dividend stocks, where the company pays its taxes on income and then investors pay taxes again on their income. But the downsides can make you rethink these cash machines. Most obvious is the price destruction we see in so many of these stocks. The highest monthly dividend yield, a stock I'm going to show you in a complete list later, has seen its share price plunge 73% over the last 5 years, wiping out nearly all of the return from its dividends. The fact that these companies pass through almost all their earnings as dividends, they leave nothing back for growth. It makes the shares extremely volatile and puts the companies at the mercy of interest rates when they're constantly drawing new loans to fund the business. No less obvious drawback for investors, until you get to tax time, is that almost all of these stocks pay non-qualified dividends. That means instead of being taxed at those lower long-term capital gains rates, around 15 or 20%, any monthly cash you collect from these stocks is added to your income and taxed at those higher income tax rates. Now, that does not mean you should give up on monthly dividend stocks, because there are ways around these risks, and it starts with deciding if you need that cash flow to pay for the bills now or you want a higher long-term return. And the question is more important than most investors realize and is going to determine which dividend strategy I'm going to show you next is right for your portfolio. So if you are depending on your monthly cash flow right now to pay the bills, you might go with the higher dividend yields you can find and not worry quite as much about the falling stock price. That doesn't mean you totally ignore price returns, because the stocks with the worst of the plunging prices are also the ones that cut their dividends the most. Now, if growing your portfolio for that future cash flow is more important, though, you want to look for a balance between price return and yield, something I've tried to do in ranking these monthly dividend stocks for this video. This all means there's one of 2 strategies here depending on your goal and your needs. If you don't need that dividend cash flow now to pay your bills and are more focused on growing your portfolio, so that balance between price return and yield, then it's best to hold these high dividend yield monthly payers in your retirement accounts. That way you pay no taxes on your dividends until they're withdrawn in retirement. Keeping every penny of those dividends and allowing it to compound over the years is going to be a big boost to your portfolio. If you are spending down some of those dividends or focused more on the highest yields possible, holding these in regular taxable accounts with some of your growth stocks is going to open up a whole nother opportunity. In fact, it actually turns the falling stock prices on monthly dividend stocks to your favor. As an example here, if you invested in shares of Nvidia in 2022 when I first started recommending it as one of my forever stocks, you'd be sitting on a 354% return, but also a massive tax bill if you sold any of those shares. At $1,100 a share, the taxes alone on a 15% rate on those long-term profits would be $128 for every share you own. The strategy here then is selling some of your shares of monthly dividend stocks that have fallen in value as you take profits on your tech stocks to help cancel out some of those taxes. Any stock losses you book each year are offset against your profits, lowering your total tax bill. You get to keep on collecting those high dividend yields and use that falling stock price and monthly payers to your benefit. Stellus Capital Investment, ticker SCM, with its 11.5% dividend is another safety pick here on the list, but with little or no price return. Stellus has nearly all, 97% of its loans in that first lien or senior secured debt status, which means it gets paid first even if a company defaults. Almost all the portfolio, 98%, is floating rate, so all in all, this is one of the safer BDC strategies you're going to find, along with PFLT earlier. And history here shows the company's commitment to cash flow, with over $15 per share paid out as dividends since the 2012 IPO, even if the share price hasn't produced much of a return over the last 5 years. Stellus has managed to grow the dividend by 17% over the last 5 years, producing a 68% total return over the period. For monthly dividend stocks, that safety and first lien and floating rate is a big plus in my book, so maybe that affected my ranking here. Now, the company only makes an average yield of 11.9% of its portfolio of loans, so you're not likely to see much in the way of price returns on this stock, but it should go on paying out that consistent dividend. Ellington Credit, ticker EARN, with its 13.4% dividend, is a riskier stock here, but could surprise investors over the next few years. Ellington is a mortgage real estate investment trust, an MREIT, which instead of owning physical property like other REITs, its strategy is to invest in mortgages. So MREITs borrow money at short-term rates, usually much lower, then leverage that to buy 4 or 5 times as much on their mortgages. That business model has been turned on its head, though, with a jump in interest rates over the last few years, and MREITs like Ellington have seen their share prices plunge. EARN itself has seen the stock price drop 33% over the last 5 years. That and a feeble 21% total return might have been enough to keep it out of my top picks list, but when interest rates do start to come down eventually, we could see a big turn in these MREITs as well. Even despite the tough environment, Ellington has been able to grow its dividend by 71% over the past 5 years, so you've got that strong commitment to shareholder cash return. We're coming up on that top monthly dividend stock I'm buying, but stick around. I'm going to show you the complete list of monthly payers with yields over 6%, 20 stocks that pay you every month, and how they rank on yield and return. If you want more dividends though, and I know you do, be sure to watch this video next, the one quarterly dividend stock I'm buying right now. It might not pay every month, but it's one of the highest yields and total returns you're going to find. My favorite monthly dividend stock right now, though, is the best of both worlds with return and yield. PennantPark Investment, ticker PNNT, with its 13% dividend and 110% total return. That total 5-year return is the highest among the 20 monthly payers, something you wouldn't expect on a stock that pays a high 13% yield. And whereas that PennantPark floating rate, that PFLT, focuses on first lien senior debt, PennantPark Investment is more broadly focused across the capital structure. While 58% of the debt here is first lien secured, it is a little riskier portfolio with 22% equity and 13% subordinated debt. That additional risk, similar to what we saw in Horizon Technology, feeds into the higher dividend yield and will generally mean a higher price return when times are good. You see that in this 1-year chart here with shares of PNNT up 33% along with that dividend. PFLT is also up here, but a more modest 6% on top of its 11% dividend. Now, there is nothing wrong with holding both of those, the PNNT and the PFLT, but for the sake of diversification, I'd probably just go with one or the other. I like the extra equity kicker here with PNNT for that potential upside, but PFLT would be the safer bet for investors that don't want quite as much risk. Now, I don't want you rushing to invest in stocks just because I recommended them, so here is that complete list of monthly dividend stocks with their yields, price return, and total return over the last 5 years. Now understand, I filtered some stocks out here to show only the best. I narrowed the list to only those with a 6% or better yield because if you're investing in these monthly dividend stocks for all their risks, you deserve at least a 6% dividend. I also excluded monthly stocks trading on the OTC markets or the pink sheets. You can tell an OTC stock usually by having a 5-letter ticker, or it's going to say OTC markets instead of NASDAQ or the NYSE. Nation, there is just not enough regulatory oversight on these pink sheet companies, and they're fraught with accounting shenanigans and even worse. There are plenty of monthly dividend stocks trading on the NASDAQ and the other formal exchanges. You don't need to take more risk than is necessary. I've ranked these by dividend yield, but notice the top payers aren't necessarily the best investments. In fact, the 2 highest dividend yielding stocks, ORC and ARR, have the highest negative total return over the last 5 years. That double-digit dividend yield might be exciting, but what good is it if the share price drops so much that it wipes out your cash return? It is your decision though, with that tax loss harvesting strategy, and if you just need that highest cash flow possible, then maybe those higher yielding stocks make more sense. You can use some of that price destruction to offset your capital gains in your other stocks. I've tried to strike a balance here, though, between high yield and price returns to maximize that cash flow, but also book the highest total return possible. One more thing to notice, though, is that many of these real estate investment trusts, the REITs like Gladstone Commercial, EPR Properties, and even investor favorite Realty Income, have produced some of the worst total returns of the group. Against the fastest interest rate increase in 40 years, commercial real estate has been slammed, with stocks in the sector posting a return of just 2.3% over the past 5 years. By far the worst performing sector, and well under the 90% return on the broader stock market index. But real estate is still a great long-term asset, and when interest rates do start coming down and we find ourselves out of that current crash, these monthly dividend REITs could bounce back to become some of your best returns on top of those solid dividend yields. So I wouldn't completely ignore them either, because they posted those poor returns in the past. Get your free report, the stocks I'm buying for the next 30 years, my forever stocks, up an average 94% last year alone. That report is free with the link in the description, or click on the video to the right for the one dividend stock every investor needs. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.